what is the difference between investing in a private fund versus a real estate investment trust? How many people heard of REITs? REITs? Okay, so you know what I'm talking about. REITs pay you a dividend. It's like investing without knowing what they're going to buy. You have no idea. You just buy stocks in the stock market. And they pay you a dividend. So quarterly or semi-annually, they pay you something. Now, historically, they paid 4.25%. Isn't it better to go in a private fund where you know your money is invested in this apartment building and you may be getting 5-6% and some more on the upside and they cannot play games with you? Yes or no? Because people want to play games with you are not going to go filed with the SEC. Thieves will not tell the SEC, hi, I'm a thief and here's my social security number, I'm going to go raise money from people. A thief is going to come in and tell you, hey, quick, I got this quick deal. You give me money, I give you 20%. In, out, 90 days. That's the modus operandi of a thief. You understand my point? He's always in a hurry and always a quick deal and you're going to get so much more money. But there's no paperwork, there's no filing with the SEC, there is no promissory note, there is no security against any collateral. It's a complete disaster. Okay, the offering. What is an offering? This is the private placement memorandum. PPM is private placement memorandum. It's also called sometimes PPO, private placement offering. BP is a business plan. So you're going to start by drafting a business plan. I'm going to buy this building. I'm going to do this to it. And then you're going to send that business plan to the attorney. And I'll show you how to draft a business plan today. And I'll show you how to do it in 1 hour. That means when you leave, you can do it tonight. How many people like that idea? By the way, I became a broker in California in the early 90s. I passed the exam and became a broker. I only took the broker license so I can get updates. I've never listed properties for others. I'd never represent others. I have no interest in making 6% or 4%, whatever they make. Make a lot more just doing my own deals. But it's interesting to tell you that one time I took a class from the brokerage, the Real Estate Association of California, 2 days for how to write a business plan. It takes me 1 hour to write a business plan. It takes me 15 minutes to teach you how to write a business plan in 1 hour. That is the same business plan it took me to write a business plan for a bank, and it was approved by the Commissioner of Financial Institution. That's an orgasmic session. It's a great one. Really proud of it. Okay. So you write the business plan, you submit it to the attorney who puts it in a PPM, in a private placement memorandum lingo, which is all the legalese. For example, in that they put a paragraph, investors may lose all their money in this deal. And you're thinking to yourself, they can't lose all their money. It's impossible in real estate because there is land and the land has value, the building has insurance. That's what you're saying is impossible. The SEC attorney is going to tell you, I must put that because the SEC wants me to put that. So when an investor that's accredited reads this, they laugh at it, they understand, and they still invest. But if it's an unaccredited person who is not sophisticated to understand what a fund is and real estate, they may get scared and not invest. Because if you study where people that raised capital had problems, usually the problem is not you. I'm going to assume you're all going to be syndicators. Is that a good assumption? You're all going to raise money for good projects, and you're going to make money for the investors. The problem they found out is usually the complaints that come to the SEC are from people that you raise money from who are not accredited. They're non-accredited, and they gave you their last dollar. So let's say your minimum investment is $25,000, and they gave you $25,000. And the deal is for 5 years. You raise from a bunch of people, and you got a property in Downey, and you're fixing that apartment building, and you're going to sell it in 5 years. And it's 2 years into it. That non-accredited person calls you up and says, I changed my mind. Can you give me my $25,000 back? And you say, no, you know, I gave you the private placement, and it said it's going to be for 5 years. There are 3 more years left. We just fixed the roof. We just did this, and we're now raising rents. It's going to be very valuable the next 3 years. Please stay with us. That's what you signed. You signed this qualification question, subscription agreement. I disclose everything to you honestly. I don't care. I want my money. My daughter's getting married. She wants a big wedding, and I'm changing my car. You better give me my $25,000. And you say, I can't. This is not liquid. It's not publicly traded. It's a private fund. What does the person say? I'm calling the SEC. They call the SEC. SEC, first of all, is going to say, are you a sophisticated, non-accredited, or are you an accredited person? Are you high net worth? Are you low net worth? All I had was the $25,000. So, do you own your own home? I live in a rental and I go to work on a bicycle. And I met Jenny in a bus. Jenny's going to be suspended from raising capital. She may be penalized. She may go to jail. Are you with me on this? So what's the best solution? Is to do what? Disclose everything in the PPM, and when you are following the regulation D506B, it's somebody that you know, and you document how you met them, and that you gave them the proper paperwork. And that's you're protected. So if they complain to the SEC says, well, we got the PPM, it says right here 5 years. It says it's non-liquid. It says you can run the risk of losing all the money. See, so the attorney is complying with the paperwork that the SEC wants to see. That helps you. Is that good? You understand my point? Unless you deliberately lie, that's a big problem. But if you follow everything. So now what I do in my funds, and I suggest for you to do the same, I'm going to give you a few bullet points as we continue, is you always put a paragraph there that says that if one person wants to cash out prior to the end of the fund exit, we may actually have his or her shares presented to the rest of the investors that are in the database. So I can go to Alan and say, Alan, I know you want to cash out. Let me present it to the whole group. Let's say we're all in one syndication. I can say, everybody, Alan has 2 shares of 25,000 each. He needs to be cashed out. Anybody interested? And maybe Brian says, yes, I like the project. I'm going to buy 2 more shares. They pay 50,000. We pay Alan. Is Alan happy now he's out? Yes. And Brian is happy he got more shares because there's better cash flow and there is a good exit and he can see it. So I also put in my funds. I have in my funds, I put my own money in the funds. I have family money in the funds. So I say that I have the right as a syndicator, if anybody want to cash out sooner, that if need to be, I can actually buy the shares and cash them out because I can use my own money. Are you with me on this? So that is number one problem in the world of raising capital, is people that are non-accredited wanting to cash out sooner than expected. So if you do everything right, it's not a problem because you will always be able to help them out.